Welcome back to the deep dive. Today we're getting into Chapter 7 of the SIE materials, packaged products.
Which, it sounds like something you'd buy in bulk at Costco.
Right, but we're actually talking about the engine of the American retirement system. We're talking about mutual funds.
It's a huge topic. And our mission today is to really get past that generic, it's a basket of stocks definition.
Yeah, we need to look under the hood.
Exactly. We need to look at the legal structure,
Mhm.
specifically the open-end management company, because that structure, well, it dictates everything else.
And how you buy it, how you sell it.
And most importantly, how you pay for it.
That term open-end, that's really the first hurdle, isn't it? It's not like a regular company with a fixed number of shares.
Not at all. These funds are constantly creating new shares for buyers and, redeeming shares from sellers. The whole capital pool is alive. It's shrinking and growing every single day.
Which is why you can't just trade them on the NYSE all day.
Right. Since the fund itself is the counterparty, they have to calculate the value of the entire portfolio just to price one share.
That sounds like a logistical nightmare.
It is. So they only do it once a day, usually at 4 p.m. Eastern, right when the market closes.
Okay, so this brings us to forward pricing, which means if I place an order at, say, 11:00 a.m.,
You're essentially flying blind on the exact price.
I'm just agreeing to buy at whatever the next calculated price is, the net asset value or NAV.
Mm-hmm. It levels the playing field, so everyone who buys or sells that day gets the exact same price. If you need that intraday liquidity, buying at 10 a.m. and selling at 2 p.m.
A mutual fund is not for you.
No, you'd want a closed-end fund or an ETF for that, something that trades on the secondary market.
So the structure dictates the timing.
Yeah.
But the price, it's not just the NAV. We have to talk about the load, the sales charge.
The alphabet soup of share classes.
A, B, and C. It's basically a menu of when you want to pay the sales team.
And that choice, it really depends on your time horizon and the size of your investment.
So let's start with Class A. That's the front-end load.
Yep. You pay the fee immediately. It hurts a little to see $1,000 instantly turn into, say, $950.
But mathematically, it's often the best deal for long-term investors.
Right, because the ongoing annual expenses are lower. And Class A is the only one that offers breakpoints.
The volume discounts. The more
Yeah.
you put in, the lower the percentage fee.
But here's a little insider trick. You don't actually need all the cash today to get that discount.
You're talking about the letter of intent, the LOI.
Exactly. You can pledge to invest a certain amount, maybe $25,000 over the next 13 months. The fund gives you the lower fee on your very first dollar.
But it's non-binding, which sounds great.
Well, it is and it isn't. They won't sue you if you miss the goal, but they will retroactively charge you the higher fee. They just liquidate some of the shares they were holding in escrow.
That is a crucial detail. Now, compare that to Class B shares.
These are the back-end load or contingent deferred sales charge.
So you put your full $1,000 to work right away.
You do. But if you try to leave too early, you get hit with a penalty that goes down over, say, 5 to 7 years.
And after that, they often just convert to Class A shares anyway.
They do. Then you've got Class C, the level load.
No big fee to get in, no big fee to get out after a year, but
The higher annual fee that never, ever goes away. These are really just for short-term holds, 1 to 3 years max.
and lurking under all of this is the 12B1 fee.
The marketing expense, yeah, it's deducted from the fund's assets to pay for distribution. Even a so-called no-load fund can charge this.
As long as it stays under 0.25% a year.
Yeah.
So no load definitely doesn't mean no fees.
Never. Always check the expense ratio.
Okay, before we wrap, let's talk strategy. The text highlights dollar cost averaging.
Right. This is where you invest a fixed dollar amount, say $500 every single month, rain or shine.
It takes the emotion completely out of it. And the math is kind of beautiful.
It forces you to be contrarian, really.
Yeah.
When the market tanks and prices are low, your fixed $500 buys more shares.
And when the market is flying high and everything's expensive, you naturally buy fewer shares.
So over time, your average cost per share ends up being lower than the average price per share during that period. It's just disciplined investing.
So we've hit the structure, the pricing, the whole fee menu. But there's a bigger question here about value, isn't there?
I think so. We've been talking about actively managed funds, but there's another product out there, a unit investment trust, a UIT.
And that's just a fixed bucket of stocks, right?
No.
No one is trading it. It just sits there until it matures.
Exactly. So if you believe that markets are efficient, that all the news is already priced in.
Is it actually worth paying a mutual fund manager
Yeah.
and paying those 12B1 fees for them to try and beat the market?
Or are you better off in a dumb bucket, like a UIT that just buys and holds?
That is the debate to take with you. Thanks for listening to this deep dive into packaged products.